Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today we are talking to Jordan Zinberg of Bedford Park Capital, and he lives in a little universe of Canadian stocks, small caps, no commodities. And this market has kind of been like a Frank Costanza market, Serenity now. It has been very challenging. We are seeing declines of 30, 40, sometimes 50% on some of Jordan's favorite names. He does not shrink away from that pain. He talks very candidly about where it makes sense and where it doesn't, and where he sees buying opportunities. So let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Jordan Zinberg, thank you so much for coming back on the podcast.
Thanks for having me.
I'm going to start with your own words. When you were on in March, you said you have to be willing to accept a 50% drawdown to go up 5x or 10x. And I feel like investors in your kind of stocks need to hear that right now, because it's been a little bit of a messy couple of months for your world, which is those small caps that are not commodities in Canada.
It's been a very tough tape, and it's misleading because if you look at the TSX or even the TSX small cap index, they've both done very well this year, but it's been a very narrow market. There hasn't been a lot of breadth. So if you look at what's worked in Canada this year, it's been largely mining. I actually wrote a piece on it for our Q3 investor letter. Outside of mining, the big banks have worked. But as you say, if you look at small cap growth, particularly tech, it's been a very, very tough year for some investors in Canada, depending on where your funds are allocated.
So what does that look like for you in the fund? You've been here before.
Mm-hmm.
So does it just feel like one of those times? Does it feel a little bit different?
The market feels washed out to me right now. And when I say the market, I mean the corner of the market that I focus on. So maybe I should be more specific in that. I think the other thing that I've really noticed is Q3 earnings was very different than what we've seen the last couple of quarters. And what I mean by that is we saw a lot of companies that missed, which we haven't seen much this year. We saw a lot of companies that reduced Q4 guidance. And if you think about that, that's a little bit surprising because they're sitting there reporting in November. They should already have a pretty good idea of what their Q4 is going to look like prior to that. And then they had companies reducing guidance. We even saw a couple of companies that didn't even file. They had some issues with their financials. A good example would be Ag Growth, the ticker's AFN. They didn't report and the stock was down 40% the next day. And this is not a tiny company. This is a couple $1 billion market cap. So it's been really interesting to see, but investors have been punishing names. We're also in tax loss selling time. So you have this confluence of events right now that's been happening, resulting in some areas of the market being very weak, while other areas of the market have been very strong.
So again, at a high level, what do you do in the portfolio? Do you take that as a buying opportunity? Just hold the names that you love? Have you been raising cash, waiting for this storm to kind of blow over?
It's a little bit of all of that. I mean, we're generally pretty fully invested. We don't really try to time the market. So it's not like I had a pile of cash sitting around. Obviously, we have money coming in each month and we can deploy that as needed. I think what you really have to look at is you look down your book, whether you're a retail investor or a fund manager like me, and you say, what are my highest conviction names? What are my lowest conviction names? Would I like to take money from some of my lower conviction names and add to some of my higher conviction names? And that's a process that I went through a couple months ago and continue to go through. It's a process I went through in 2022 as well, the last time we saw a major drawdown in small cap growth. And that repositioning is what sets you up for the next up leg. But you you really only have two choices. You either ride it out and you're confident in your names and you know that they're going to come back, which they generally always do, or you try to outsmart the market, which is not easy to do. Some can do it. Most can't do it consistently. In my experience, trying to time is very difficult. I'd rather just own really good quality names and know, as you said, that we are going to see 30, 40, 50% declines. And it can be not because there's anything wrong with the companies. I mean, many investors watching will know that Berkshire Hathaway's gone down 50%, I think 4 or 5 times over its history. And, that's one of the highest quality stocks that there is. So I think if you're going to be an investor in our space, you have to be willing to accept that volatility. And if you're not, stick to large caps, stick to safer, less volatile investments.
Okay, so we're like 3 minutes into the podcast and everyone's screaming. I can hear them. What about goeasy? And I promise it's a long podcast. We're going to get to it. But I think it's important to remind people about your process in these downdrafts. But also, you're not saying that everything is sunshine and roses. You are looking at earnings and they are deteriorating. And I think everyone looks at the TSX and the headlines on the economy and say, whoa, the TSX is at record highs. Even the big banks, while it seems like our economy is struggling, is it fair to say this is where the struggle is showing up? Like ag growth, is it tariffs? Is that kind of what's affecting or its ability to report results, or is it something a little bit more?
In their case, it was an issue specific to their Brazil business, which I don't think we actually know what the issue is yet, although there's been some speculation. I think part of it, depending on the business, is general weakness of the consumer. I mean, let's look at some of these consumer companies. Coke having a bad quarter, which you never see. Chipotle, which has been a market darling, down at multi-year lows. You're seeing that the consumer actually is not that healthy. And there's a bit of a disconnect, like you say, because the banks are doing very well. I think that's because people are looking at them as a safe haven. Mining, every 5 or 7 years, we get a mining cycle. We're in that right now. And that really does two things. Not only do the mining stocks do well, the mining stocks attract capital from generalists who may not be in mining for the other 5 years, but when you get a hot mining cycle, they rotate. So not only do you have capital moving out of those non-resource names, it becomes a very bifurcated market. And I think my view is I'll be happy the other 4 or 5 years and take my lumps during a mining cycle rather than trying to chase a hot mining market, because those resource markets can turn on a dime.
How do you think about a hot AI market? And I know you're not going to have NVIDIA in the portfolio. It just seems like NVIDIA's fortunes, the AI fortunes, it matters to everybody, whether you're in that or not. Because if that trade fails, if the financing dries up for that, how on earth is it going to come to Canadian small, non-commodity small caps?
Yeah, and I'm not an expert in AI, but I think what you have to look at is how is it affecting each business, and thinking about, is it going to benefit the business? Is it going to hurt the business? And with a lot of companies, I think it's really too early to say. I think you're going to see a little bit of both for a little while. So I don't think anyone knows exactly how that's going to shake out, and it's moving very fast. But I think the way to do it is just look company by company and decide how you want to be positioned.
But it must affect fund flows. Like when you were saying how commodities suck money out of your sector, this must be huge.
Yeah, although I think up until now, given that it's been attracting a lot of speculative money up until recently, obviously there's U.S. large caps and things like that. But in Canada, when you look at the plays, a lot of them have been, things there. People just slap AI in the name or somehow try to integrate it in the process, go out and hire some IR, promote the stock, make some money and move on. So I think you really have to be careful because, every investor who's been doing this a while has seen bubbles. They've seen cannabis, they've seen, all kinds of different bubbles and crypto, what have you. So I'm not saying this is a bubble. I'm just saying you have to be very careful when you see the valuations where they are on some of these names.
Okay. Enough of your process and where you stand. Let's get into goeasy. I think a lot of people think of you as Mr. Goeasy. You were saying, do people come up to you in restaurants and ask about?
I've had it, and I think some years maybe I want that title and some years I don't. This is a company I've been following for over 15 years. I know it extremely well. Obviously, the stock is at 52-week lows. It has not done well. Many viewers will know there was a short report that came out, I think it was about 8 weeks ago now. So there's been a lot going on in this name. There's been a CEO transition early this year. There's a CFO transition going on. They're launching a credit card product. There's just a lot going on at this name. And I think there's a lot of common misconceptions about this company as well. And I also think it tends to be extremely volatile. So the last time, if you look at COVID, for example, I may not get all of these numbers right, but I believe the stock was about $80 just before COVID, and it hit low 20s. I think 22 was the low. So the stock went from 80 to 22 with all the COVID weakness, and then it went from 22 to 218 or something like that. So we saw the stock go down 75%, and then we saw it 10x off the bottom. So this is a stock where the operating results have been very steady over the years. If you look at them, the company generally produces a 20 to 25% ROE. But what happens is the multiple that investors are willing to pay for those earnings goes up and down. So when the stock's at highs, it usually tends to trade between about 10 and 12 times earnings. And when it's at lows, we see it down in that kind of 5-6 times earnings. And that's really what we've seen this year is we've seen the stock go from trading around 10 times earnings to around 6 times earnings currently.
Before we dive into what was said about the company and how you feel about what was said about the company, what have you been doing with the stock?
So we have not bought or sold any. If I wasn't so full on the position, I would be a buyer. We're definitely not selling down here. The business is healthy. They've grown their loan book to over $5 billion. This is a company, just for some perspective, that 5 years ago had $1 billion loan book. So their loan book's gone from $1 billion to $5 billion over a 5-year period. What does that actually mean in terms of profits? Well, an easy way for investors to break this down so they don't have to sit there and do all the stuff I do is for every $1 billion of loan book, it's about $5 of EPS. That's the rough math. So if you think about a $5 billion loan book, that would give you about $25 of EPS. That's a go forward run rate. And the stock's at around $120. So when you sit back and look at that, and this is a stock that's compounded at a very high rate for a very long time, they're still very small in their home market. So again, for some perspective, the non-prime market in Canada is about $200 billion. goeasy sitting around just over a $5 billion loan book. So it's a very small percentage of the market. And that's just Canada. They're only in Canada. As I mentioned, they're also launching a credit card market product. That's a $60 billion market in Canada that they've never been in before. So there's a lot of exciting things happening. But investors in this name do have to be patient because it is a volatile name and it's going to trade up and down and the multiple is going to trade up and down. But if you look over the last 10 years, it's compounded about 20% a year.
Let's talk about the specific allegations. Again, it's a Canadian subprime lender.
Yes.
And in many ways, that is a favorite punching bag of short sellers because when there are cracks in the Canadian economy and delinquencies go up, which they are going up at goeasy, you can take a hard look at these companies' practices and what are they doing. That the headline allegations are that it's understating the credit risk and artificially inflating its earnings, that it's relying on things like aggressively like borrower assistance tools and not putting people into the distressed bucket that they should be. So you're kind of not moving, an account that is distressed into delinquencies, for example, because you found creative ways around that. Did I kind of capture the short report? Or
most of it, yes. I think that, we could probably spend the whole hour talking about this, so I'll try to summarize and keep it pretty high level. The short report pointed out some things that for people who know the company intimately well were just sort of ridiculous. And I'll give you an example of that. One of the things that they talked about was the fact that goeasy's charge-offs are actually moving lower when the rest of the industry's charge-offs are moving higher. And they were kind of pointing that out as if there was something nefarious going on. Well, in fact, the business has changed quite a bit. So if you go back 5 or 6 years, goeasy was predominantly doing unsecured loans. And then about 4 or 5 years ago, they bought a company called LendCare that specialized in lending against things like boats and sea-doos and things like that. So they started doing more secured lending. They also started doing mortgages, so secured by houses. So all of a sudden, the business started changing a lot where the secured portion of the business has gone from about 10% of the book to about 50% of the book. Well, if you have more secured lending in your book as opposed to unsecured lending, logically, your charge-off should move lower. So when they pointed out that the charge-offs are moving lower and that something, obviously funny is going on, it's actually not the case. The case is that the business has changed.
And so that boiled down to the point of they're no longer writing things off if they're delinquent or past due 180 days. And that is something, is that how?
So that's a separate point. It's a related but separate point. What that has to do with is if you're lending against a car and somebody doesn't pay for the car and you have to go recover the car and then sell the car, that whole process is going to take a little bit longer than just writing off an unsecured loan that goes bad. So that's why the duration of those collections has spread out. And they've also been doing just more longer term loans. So I think the US short sellers are very good at making a very long report that doesn't really say a lot. Some of the stuff in that report was just factually inaccurate. Some of the math was correct, but it wasn't explained properly. But at the same time, whenever you see something like that, you have to really look at it. So I actually sat and read that twice carefully. And I did look at some of the things they were talking about. And I did speak to the analysts who cover the stock to see if they had concerns or if there was something I was missing. But these short sellers tend to prey on things like CFO resignations.
Well, that's what I was going to ask you about. So you have an accounting change and a CFO resignation. You've known this company for a while. So I assume you know the former CEO, Hal Khoury. You know, when there's smoke, there's fire. An accounting change and a CFO leaves. Does that not put up any spidey senses?
Well, CFOs leave all the time. I mean, I'm used to that. So just a CFO leaving alone doesn't really alarm me. If let's say a CEO left.
And the CEO left.
Or sorry, a CFO, let's say they left immediately and, they weren't coming back. Not, the CFO is going to leave and we're going to have a transition and he's going to stay for 4 months and so on and so forth. The former CEO, Jason Mullins, I know very well. He was excellent. I was very upset to see him go. He's now off doing something in the US. And I think, he's a gentleman who likes to build businesses, and he didn't really like all the investor meetings and government meetings and other things that he had to do. He likes building companies. So he went to go off and build another company, and I wish him well. He's very good. But, to say that every time a CFO leaves, something is wrong, that's not necessarily the case. But like you said, they look for these names that might be in out of favor sectors, misunderstood sectors. There could be a management shakeup, accounting changes. All of a sudden, they get short. They come out this report, stock goes down, they make their money, and they move on to the next one. And we've seen them short a lot of really high quality Canadian names, and sometimes it works and sometimes it doesn't work. But generally, there's sectors that investors are fearful of anyway, or may not really understand to begin with.
So there was a short report on September that obviously took the stock down. But what else took the stock down recently were earnings.
Yep.
They weren't good. At least that was the street's kind of view of it. There was higher than expected, like bad debt expense. So again, linking these two things together, you've got somebody saying it's worse than the company is suggesting. Then the earnings come out and they are quite ugly. And the company itself admitted, there is stress in the system. To your point about the Canadian economy, there are people that are struggling.
Yeah, so let's make sure we get the terminology right. So bad debts actually weren't worse. What they did was they took additional provisions. So the best way to understand these lenders is that bad debts are backward-looking and provisions are forward-looking. So their bad debts were actually fine. They did take some extra provisions given the economy. And the way that lenders have to provision according to IFRS accounting is they have to do a risk assessment of the economy, and then they have to go in and make some assumptions and weightings about what will happen to their book. So goeasy took a bit of an extra provision going forward to be cautious. And if you backed out that extra provision, the earnings were actually right in line. I think it was 464 of EPS, something like that. And they reported 417. I think those were the numbers, something close to that. If you backed out the extra provision, the numbers were right there. And the quarter was still decent. I mean, this is a highly profitable business. So I think, to your point, nobody likes bad news. So when you come out and say, we took an extra provision and then our earnings were a bit lower, there's also a lot of investors who just trade around quarters. I mean, we're in a different type of market. You have quant investors who are just loading up on stocks before quarters. When the quarters come out, good or bad, they're selling. I've seen some crazy things with some of these quants, where take a company like goeasy, they'll go and sell the stock at $125. And then when it starts to rebound, they'll come back and buy it at $180. And that's why you don't see a lot of quant funds as top performing funds in my experience. But I'm sure there's some good ones out there. I'm not trying to insult anybody, but generally the way they trade, they're just sort of following trends and they're not doing any fundamental analysis. But you can get this, what we call quant flush after earnings, where all the quants will just be selling. And it creates a bit of an effect because then you have retail investors who may not know the companies very well. And they say, this stock's down 10 or 15%. Something must be wrong. And they start selling. So it creates a bit of a negative feedback loop. And eventually the stocks find a level where the fundamental buyers come in. And I feel like we're getting there on a lot of names right now. A lot of names that I watch are really washed out and they're trading at, like I said, 5-6 times earnings. And these are growth stocks. These aren't distressed companies.
So on the issue of credit quality, I think you've addressed that. On the CFO departure, you've also addressed that. Are they being too aggressive on things like the borrower assistance tools? And I know on the conference call, they were asked specifically about that. Do you have a good handle on how they're using borrower assistance? I think the CEO said, it's not so that they they still try and make sure that they're first in line for payments, but that there are other ways that they can help people.
Yeah, so I think, when you talk about these short reports, sometimes good things do come out of them. And one of the things that came out of this was the company had never really talked much about that. I knew they had these programs. It wasn't really something that came up much. But after the allegations in the short report, the company actually did quite a decent job, I thought. They did a full slide in their investor presentation for the quarter talking about what the programs are and how they're used. They talked about how they've been used relative to the past. So in some cases, these short reports can actually be quite beneficial because they do draw out some issues that maybe haven't been in the spotlight before. So I think the company did a good job explaining what happened and how they use the programs, and the fact that a single employee can't just go rogue and put a bunch of borrowers. I mean, this is a fairly large company. Keep in mind that the governance is quite strong. The former chairman's still on the board. The former CEO is still on the board. And it's also being run by a gentleman now who was a top banker at Scotiabank. I mean, he didn't get the CEO job recently, but it's now being run by a banker. So if you think about that, I was actually a little bit concerned when I saw the CEO appointment, because sometimes when you have these non-prime lenders and they bring in somebody from a large bank, the banker tends to just come in and de-risk the company, which can take away a lot of the growth. So I was actually a little bit concerned that they brought in a banker. So if anything, it's the opposite. You're bringing in somebody who's very used to a very high compliance environment and a different type of environment to an entrepreneurial, fast-growing non-prime lender. So I'm actually going to meet with him, with Dan next week and get a bit of an update. But I think if anything, the governance of this company is quite high and the inside ownership is quite high.
What do you want to know from Dan? Like there must be, are there self-help levers that you'd like to know if they're going to push on? I know, on the call they were asked about buybacks. What's your capacity for buybacks?
And they've been pretty aggressive with their buybacks. I think it's more of an update meeting, so it's not that I'm going in there with a highly specific agenda. Obviously, I want to know what they're seeing out there in the economy. I want to talk about their credit card product, which I think is going to be a huge driver of growth. I want to talk about capital allocation. They generally, in January, in February, when they report, they come out with their 3-year targets, and they usually raise their dividends. So I want to know, maybe are they going to look at more buybacks this year as opposed to dividends? Because the stock is so low. They were buying back stock at, I believe, around 160. The stock's 120. So if they liked it at 160, they should like it at 120. Company has a lot of free cash flow to buy back stock. But yeah, I look forward to chatting with them.
Let's bottom line it. The stock was around 214 in September before the short report. Then now it's trading at around 122. Does it make sense that there is weakness in the stock, just given the earnings that they reported and the provisions are going up, signaling, there is some stress in the system? Like, in your estimation, where should the stock be trading?
For a company of this caliber and this consistency and this growth rate, I mean, you could easily argue for 10 times earnings or higher. We're at about 6 times earnings. So using the example I gave before with a $5 billion loan book and $25 a share of EPS, put a 10 times multiple on that, you get to 250. I believe some of the analysts even have higher targets than that. That being said, I think the comparison is also always to the Canadian banks, because even though it's not a bank, some investors sit there and say, well, should it trade at a lower multiple than the bank? Should it trade at a higher multiple than the banks? I could probably make a pretty viable argument to you both ways, to be candid. But I can tell you that a company that grows at 20 to 25% consistently should not trade at 6 times earnings.
All right. Well, I think I bought this the last time that you were on. So
Sorry about that.
I'm rooting for you. No, okay, I still held. So we'll see how that goes. Okay. That was our Go Easy conversation. I hope that it satisfied everybody who had those questions.
Let's see what it looks like in a few more quarters when I'm back on the show. That's
right. Exactly. And we will check up on those picks. You'll see that later on in the show. It's funny, I joked, you're Mr. Go Easy, but I know a little bit about your background and who you came up with Jason Donville, who's kind of like Mr. ROE, return on equity. And I think about him as like Mr. Constellation Software. And I wonder, how close you still are to that name or were to that name, because that's another curious area of the market. It's definitely larger cap. It's been just an absolute star performer over the course of its history, except this year. And I I have to confess, this is the year that I bought it. So
Good for you.
Of course it's
well,
down.
depending on where you bought it.
Yeah, no, I'm down. That's sort of my gift is buying star performers the year they go down. But I want to know from you what you think is going on with Constellation Software.
Sure. Well, I mean, don't be too hard on yourself because this year you've really seen quality is out of style. And that's not something I don't think I've ever said. And that's actually maybe a good title for our next investor letter. But Constellation falls into that group. As you said, this is a market darling. As you alluded to, Jason was a big investor in Constellation early. I was with him at the time back in 2008, 2009. We started buying the stock. And actually, I still have some from back then. And from my mom's account, this is stock we bought at $40, $50, which is now trading at $3,300. So let's talk about what's gone on with Constellation this year. In my mind, there's been two things that have brought the stock down. The first has been the AI threat, which, tying back to where we started, there was a short thesis on Constellation out of the US, going back to probably around the spring when the stock started to crack. And people are going, what's going on with Constellation? Because this stock does not go down. I mean, you look at the chart and it's like this. So what I think some of these short sellers were thinking was they were long a lot of AI stocks in the US and they wanted to pair it with something that they thought would get hurt by AI. So this thesis emerged whereby, and you know what Constellation does, it's vertical market software, that AI would come in and challenge and replicate a lot of the things that Constellation's software was doing for companies. So that was the thesis. So you had a bunch of, and I heard this more out of the US, not out of Canada. So you had some US investors shorting Constellation against their long AI picks. So that was kind of the first leg down. Constellation does not talk to investors very much. They do not do conference calls. They've always just kind of said, here are results. If you like it, buy the stock. And if you don't, then too bad. And that's been enough for investors when you're compounding at 30% a year. But when the stock started to crack, I think the company really felt that they had to address this concern, which they did. So they actually did a call, which I was on. It was almost 2 hours long. And they had a lot of members of their team talking about AI, talking about how they're using it in their business, why it is both an opportunity and a threat. I like that they did the call. I don't think they really came out that strong. They were admitting they're still trying to figure out where AI fits into their businesses. But a company that big with all those resources is also leveraging AI and using it. If they use it in one business, they can take the learnings from that one business and put it across hundreds or thousands of other companies. So I think going back to where we started when we're talking about AI for Constellation, it's going to be both a benefit and a threat. We really don't know yet.
Is the second anxiety that it's happening at a time where Mark Leonard, the founder, is no longer at the helm?
Yeah, so that's the second piece. So all of a sudden, Mark retired, citing a health issue, and I've known Mark for a long time, not super well, but definitely came back to our offices back in 2008, 2009. This was a 500 million market cap when we were buying it, and he actually came to our office, which is kind of funny because.
Did he have the beard?
Not back then.
Not back then. Okay.
But I mean, for those who don't know much about Mark, he's obviously very highly respected. I won't go as far to say a Buffett type figure, but just all you have to do is go on X and type in CSU, and you'll see there are a lot of very diehard Constellation fans, and anyone who's owned the stock for a period of time has done extremely well. I mean, life-changingly well in some cases. So I think Mark certainly had an aura and a ton of respect, has an aura and a ton of respect from investors. And, it's the same thing, Buffett stepping down this year. If something were to happen to him, I think you'd see the same type of thing. So you had some investors who kind of said, well, if Mark's not there anymore, I don't want to be there. I think what they didn't realize is, Mark hasn't been running the day-to-day for quite some time. This is a very large company with a very large team, and they're also very decentralized, just in terms of the way that their business is set up. So while I think Mark was obviously involved in big picture things and strategy things and the spinoffs as well, it's not like Mark was in there, working on these acquisitions. It hasn't been that way for years.
And from a fundamental perspective, I'm just looking a cursory look at the growth estimates for the company. So if everybody's worried that growth is going to slow, I actually see estimates going up, not down, for both profit and sales.
Yeah, and they had a good quarter. I actually thought their quarter was better than expected. The stock didn't really do much. I think it's really just a sentiment thing right now. The business is quite healthy. These are very dependable businesses, the recurring revenue businesses, where every January, if you run a golf course or you run a library and you use Constellation Software to run your business, every January you're going to pay your fee and you're going to use your software to run your business because it's very disruptive. When you have vertical market software that's being used to run your entire business, it's very disruptive to switch.
Now, talk to me about deals. This is a growth by acquisition company. Have they been kind of steady as you go, acquiring the same number of businesses that they typically do? Has this been a good environment for Constellation to consolidate in?
Yeah, so I think with Constellation, as you say, it's a growth by acquisition story, and every quarter investors want to see how much did they allocate, what did they spend. Now that it's a much bigger business, they've had to do bigger deals. So where in the past they could go and buy $10 million companies, that's just not going to move the needle now. That's not to say they don't do that. They still do that. They'll still do hundreds of small acquisitions a year. But I think what moves the needle now for investors is big deals. And that's really where I think you're going to see the stock recovers if they can get some big deals there, deals that are actually big enough that they announce. So they'll keep doing those singles and doubles over time. But to your point, it's going to be M&A flow that's going to, I think, dictate. And I think over time, people will get comfortable with the fact that Mark is no longer there. He's still a very large shareholder, but the management team, at least those who I've met, are all top notch. I mean, this is an excellent business.
You already own it, but would you buy more on this?
I actually bought Constellation for the first time in about 5 or 6 years. So I bought Constellation the day I started the fund in 2018, bought a little bit more that year and then left it alone. And then when I saw the dip down to about 3,200, the first leg down, I stepped in and bought some more stock. So that was, like I said, the first time in 6 years that I bought the stock. It's trading at 10-year trough valuations. So right now you're getting that stock around 20 times earnings, forward earnings, depending on how you do the math and what adjustments you make to earnings. So you're getting a company that compounds at 30, 40% a year for 20 times earnings. That's a pretty good trade-off. And it's a large cap.
All right. Well, let's see.
Only large cap I own. One of the only large caps I own.
Oh, interesting. Okay, let's see what else you got. We're going to dip into the mailbag. The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the Stock Replacement tool, and News and Insights under the Tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, our first question in the mailbag is about a company called NTG Clarity Networks. They reduced their full year guidance. What are your thoughts, I should say, on them reducing their full year forecast with the release of their third quarter earnings? Are you still bullish? This one coming from Cody.
Sure. So Cody's pretty astute because not a lot of people know this name. So maybe I'll just take a second to explain who the company is and what they do. The easiest way to explain it is it's almost like a baby CGI for investors who are familiar with CGI. So
is that a good thing right now?
Well, I'm just using it to explain what the company does. Okay. I'll answer that question after. Very similar business. So IT services is the main business. The difference here is that they operate in almost exclusively in Saudi Arabia and related countries. So the business is actually based here, but their market is there. So it's a very specific geographic focus. And what people may not know is that Saudi Arabia has a massive initiative right now to diversify away from oil. They don't want to just be dependent on oil. So they're trying to turn it into a tech hub. And they've committed billions and billions and billions of dollars to do this. And NTG is one of the beneficiaries of that. So the company came on my radar last year just through a screen, highly profitable, growing really fast, got to know management team, got to understand a little bit about what they were doing, bought some stock. And so what happened with their quarter is actually quite simple. They have been staffing up in anticipation of some big contracts, but some of that work has been pushed. So when you have a situation when you bring staff on and then the contracts get pushed to another quarter, you have the expense of that staff, but you don't have the associated revenue. So as a result, margins suffered a little bit. They did pull down their full year guidance, but let's put it in perspective. I think 2024, they did around 50 million of revenue, and their guidance for this year is 78 million of revenue. So if you just look at that from a top line growth rate, profits are also growing very quickly as well. The one thing to be aware here is they recently started paying tax. So this is a company that had tax losses before and has now started paying tax. Not only are they paying tax, they're paying tax in Canada and they're paying tax in Saudi Arabia. So they're working on some structural things to reduce that tax hit. But I just took down my own estimates a little bit just because of the tax number. So I think the two things to really know on this thing, or three things: growing very quickly, number one. Number two, some of the bigger contracts have been pushed. So the margins are just suffering a little bit. Still very under the radar. And I think probably a pretty good takeout candidate for any tech company that wants a presence in that area. They've been down there for 20 years. They actually even have their own university where they pull young people out of school and train them so that they can be hired eventually. Because that's the biggest problem is staff. So they're pulling staff from neighboring countries and things like that. But if you think of a large tech player or consultant that wants a presence in that area, to come by this company, it's going to be a rounding error for them.
It's teeny tiny. It's 55 million market cap. And normally, a company, because you said they're, they are profitable. What is this multiple? This multiple looks reasonable just on its own, 9 times earnings.
I actually have it on a lower multiple than that. Okay. Are you looking at next year or this year?
Next year. It just says that it's the estimated consensus, but consensus is
there's only one. There's only 1 or 2 analysts. So I think I have them making about 22 cents a share next year, and the stock's about $1.20 right now. I didn't look at it this morning.
Yeah, $1.17.
So let's again, we've got these profitable growth stocks trading on 5 and 6 times earnings, and that dislocation will not last. I've seen this many, many times in my career, and it sucks while you're going through it. But you just have to keep your head straight. And, as long as you know your names and you think the conviction's there and there's nothing wrong, you will see these names re-rate higher and you will see that washout stop. I can't tell you if it's going to be this month or next month or the month after, but I can tell you that when you look at how well some of these names did last year, it's not a surprise that they checked back this year. I didn't think they'd check back this much. You look at a stock like goeasy. I mean, it's been highly volatile, but I can tell you that if we look at where it's going to be 5 years from now, assuming nobody buys the company, I'm telling you that the stock's going to be materially higher.
You think so? You think someone could buy the company?
Well, it's interesting, and I don't want to speculate on rumors, but there have been people talking about the fact that there's been some foreign players that are coming to Canada. They're trying to broaden their presence. I'll give you one example. Banco Santander, if you're familiar with Banco Santander, a very large bank, actually, which a lot of Canadians aren't even familiar with. They, over a decade ago, bought a non-prime vehicle lender in Canada that was public called Carfinco.
Carfinco, yeah.
Which you might remember.
Yeah, I do, yeah.
And then, as far as I know, and I'm not an expert on this, I don't think they've done a ton in Canada since then, but somebody pointed me to some of their disclosures, and they talked a lot about wanting to increase their presence in North America. So again, I'm not trying to speculate on any specific deals. I'm just trying to give an example of the type of buyer who might say, hey, we would love to have goeasy as a platform acquisition to grow our presence in Canada. We're already in the non-prime space with vehicles. So again, I don't know nothing specific to that company. I'm just giving an example of the type of player who would come in and say, wow, 6 times earnings for a company that's growing at 25% a year. We can put a 40% premium on that. And, we're still only paying, 8 or 9 times earnings.
Well, I hope people listened after our goeasy conversation, because there's a little nugget there for you. Yeah. I want to pick up on a thread that you left dangling out there, which was CGI. Yeah. It's a large cap, so I don't know if you own it.
I don't own it, but I follow it.
It's down 18% so far this year. It's trading at around a 2-year low. Another kind of like software play that has just rolled over. A lot of issues, I guess, like the government shutdown didn't help, and its ability to grow organically after doing acquisitions has been called into question.
Yeah, well, the bigger you are, the harder it is to grow by acquisition. Obviously, that's just numbers. But I think going back to where we talked earlier, quality is out of style, and CGI is quality. And it hasn't just been tech. I mean, there's been other really high quality names. An example would be a company like First Service, which has also been a really steady Eddie compounder over the years. It's down about 20% or so year to date. And again, I don't own the stock. I don't own either of the stocks, but I really think you're seeing that sell-off in these high quality names, and that's not going to last forever. We're not going to see money piling into risky mining stocks for the next 5 years. It's just not going to happen.
All right. Well, don't tell some of our commodity investors, because they think.
Well, have us both on. We can go
duke it out.
Yeah.
One stock that we got a question on, another small cap, is Vitalhub. The question is from Arzuni on X. Is the recent decline due to a general decline in software stocks, or is it stock specific? Is it buyable at this point?
So I think the viewer has it right. It's been part of this whole tech sell-off. Vitalhub is a name that I owned very, very early, probably around $2. I think maybe sub $2 is when we started buying it. Sold it early, so I didn't get that whole rip up to 13 or 14. But the reason I sold it and the reason I think it's come down is this stock was trading on a massive multiple. And I think even now we're still trading on 23 to 25 times earnings, somewhere in that range. So you've seen it correct from maybe 35, 40 times earnings down to 25 times earnings. So I like everything about this company except the valuation. So management's very good. I've known them for a long time. They've executed. They're steady Eddie operators. They've built and sold a business like this before. I do think they will sell this business eventually. But to answer the question more directly, I would not buy the stock here just because I still think it's trading at an inflated multiple for what they have.
So that's interesting. It's actually pretty well covered on Bay Street, 11 analysts, universal buys.
You want to know why?
Do they issue stock?
Well, they're a growth by acquisition company.
Yeah.
And, there's almost two types of growth by acquisition companies. There's Constellation Software, which has never raised any equity and just takes their cash flows and buys more businesses. And then there's companies like Vitalhub that rely on the street to raise the money to go out and buy companies. And there's a lot of companies that analysts love. I mean, I could give you lots of examples where they're okay companies, they're growth by acquisition stories, but they're just constantly raising. So analysts are highly incented to cover them.
And with a buy, even though there's supposed to be a wall between banking and research.
That wall. No comments there. But anyway, so the answer is it's an excellent company. I just don't like the valuation.
Okay. Let's go to our next question. We'll just let that wall comment sit. Yeah. The question is between Kraken, Robotics, and Zedcor, which seem like unrelated businesses. But this question is from 3P Investor on X. If you had to choose between the two, which would you choose? One is a security company, Zedcor. One is like a marine technology company. Mm-hmm. But the charts actually look similar. So maybe
I think the reason that the question might have come up is these are two of the only small cap growth stocks that have actually done really well this year. Market darlings, right? I was in both stocks really early. In the case of Kraken, I was in about 40 cents. The stock's around, $5-6 now. Zedcor, I was in around 95 cents. Same thing. The stock's about $6 now. They both had huge runs. The businesses are very different. They're both trading at massive multiples right now, which is why I don't own either stock. In terms of the actual underlying business, if I had to choose a business that I like more, the business would be Zedcor. And the reason for that is they've got first mover advantage. It's a pretty high margin product. Management is doing all the right things. They're growing very fast. They're up for some big contracts. Some people have attacked the technology a little bit, saying that it's easy to displace. We haven't really seen that yet. They're full steam ahead. So I think as a business, I like Zedcor better. With Kraken, to your point, so it's an underwater technology company. So think of things like underwater drones, for example. Some of the early sales the company made, believe it or not, were to treasure hunters. So people who wanted to go down deep into the ocean and look for treasure. Now, most of their customers are military, as you would imagine. And the products are really, really cool. Years ago, they invited me out to Eastern Canada to come play around with some of the toys. I didn't actually go, but I probably should have. The reason I don't like the business as much is when you're dealing with governments and military, the contracts are very lumpy. So you can think you're getting a contract this year. You may not get it at all. You may get it in 2 years. You may get part of it. So it's a very lumpy business. Whereas if you look at Zedcor, you can easily kind of say, okay, they have this many towers in the field. They're charging this much per tower. I think they're going to have this many towers next year, and kind of back into the numbers that way.
Zedcor is down about 15% from its peak and Kraken down about 26%. Even with those pullbacks, you think they're still too expensive?
I mean, last time I checked, now everyone's going to value these on EBITDA, like your sweatshirts that you have back there, which we can talk about that after. You call
bullshit?
Well, I call it bullshit earnings, but let's actually talk about that in the context of Zedcor, for example. So investors are going to look at EBITDA, and it's going to look much cheaper than it is on earnings, but we're ignoring some important things. And one of those things is depreciation. So the towers actually depreciate. And I make this argument all the time. I actually I was speaking to a group of students at the SHLE School of Business the other day, and we were talking about EBITDA versus earnings. That question came up. And the example I gave was, let's say you have a trucking company. They own lots of trucks and they finance their company with lots of debt. And you say, well, this trucking company looks really cheap on EBITDA. But then you look at it on earnings and it doesn't look that cheap. Well, why is that? Well, you've got a trucking company, but last time I checked, trucks depreciate. So you're ignoring that. You're saying, oh, that doesn't matter that the trucks depreciate. And the company has a lot of debt. And last time I checked, banks like being paid their interest when you borrow money from them. But we're not going to talk about that either. We're going to ignore that. Oh, and by the way, the company has a 26% tax rate here in Canada. The government likes their tax money, but we're going to ignore that too. So all of a sudden we have a trucking company, we're ignoring their trucks depreciating, we're ignoring their interest costs, and we're ignoring their taxes. Why are we doing that? And I think investors have gotten a bit lazy with EBITDA. EBITDA is good if you're a private equity investor and you're looking to neutralize a capital structure and say, well, how would this company look if I didn't have that much debt or if I capitalized it a different way? But I'm going to agree with the great Charlie Munger, bullshit earnings. I don't know if am I allowed to swear on the podcast?
You can swear, yeah. It's the cash flow, I guess is how you can look at it. It's not a totally useless metric.
I'm not saying it's totally useless, but I'm saying as an equity investor, you care about taxes. You care about interest costs. You care about all those things.
So what sweatshirt should I have? What am I replacing?
I'm going to get you an adjusted earnings, Bedford Park adjusted earnings sweatshirt. For next time.
I feel like it doesn't have the same sizzle, but I am open to what that looks like stylistically.
Okay, we'll come up with an acronym.
All right, now let's dip into your pro picks, your highest conviction ideas in the market. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, before we get to your top ideas, I want to revisit some of the ones that you brought to us in March. You were on March 27th, and your first one was Source Energy, which was interesting because we talked about how you're not a commodity investor, but this is adjacent. It's been a bit of a wild ride. It's up 2% from March 27th, but it had a nice run after you picked it up, and now it's back down, kind of on poor results. Mm-hmm. Their recent results were not great. Talk to me about whether you've owned it through this period. Do you still like it?
Sure. So we've owned the stock since about $1.60. That would have been in 2021, 2022. I don't remember off the top of my head. So we've had a great return on the stock. But going back to your point earlier, these stocks can fluctuate quite a bit, given that they're small caps. And this is one that is, even though it's not a resource stock, it's energy services. It's tangential to oil and gas. So the volatility is even higher here. Plus, in this case, it's a pretty thinly traded stock. There's a couple large shareholders, including myself, and it's a relatively small company. So trading can be liquidity driven as well. You get a big buyer or a big seller in the market that can push the stock up or down 10 or 15%. In terms of the quarter, what the company cited was a very busy energy market in July and August, and then a very, very slow market in September. So when I spoke to them over the summer, I got the sense that the quarter was going very well, and other energy services companies that I talked to were saying it was extremely busy over the summer. But in September, I think you had a bit of budget exhaustion from the bigger E&Ps, and that affected their results. That being said, the company did a good job talking about the rest of the year, so Q4 and then moving into next year. And the elephant in the room here is LNG Canada, which, if viewers are familiar with, is a massive project. It's going to have a huge effect on the demand for sand. And one of the reasons I like Source so much is this is a highly strategic asset. There's only a couple sand players in Canada. If somebody wanted to duplicate this, it would be very, very difficult to do. You'd need hundreds of millions of dollars, a lot of time. Source is really, even though it's a sand business, it's really a logistics business. It's how do we get this sand from Wisconsin, which is where they bring it from, up into Canada and then out to the projects where the companies and the customers actually need it. So the quarter was a little soft. I think Q4 will be good. I think Q1 will be very good. And as we get into next year, I think it'll be very strong. This company, I think, is also a takeout candidate.
SHLE is the ticker in the Canadian market. So you owned it at $1.22. It's $10.64 today. So on a pull, it sounds like you're not fussed on the pullback.
Yeah, this is one where I actually, the company did a good job sort of talking before the quarter about their results maybe being a bit weaker into year end. So we did trim some going into the quarter, up higher, maybe around, 13, 14. and then looking to rehook it. I thought it would actually maybe hit 10 if the quarter was really bad, given market conditions. I think it hit 10.50. But happy to buy that stock back.
What about Main Street Equity, a stock that you loved? It hasn't really done much this year. We did get actually a few questions on it. And it's down about 2% since you chose it, but there were some peaks and valleys in there over the long term. And we've interviewed Bob Dylan, and I know you know him well. It's an amazing story, but this year it just hasn't been.
Yeah, listen, I wish, you look at this stock, it's compounded at about 18% over 20 years is the math. I wish it was 18% a year. I wish it was like a machine where you just put in a coin and you get your 18% every year and that's it. Unfortunately, that's not the case. Unfortunately, we're going to have years where the stock's up 40% and we're going to have years where the stock is, I think this year's down 8 or 10% or something like that. Nothing at all changed in the business other than the fact that maybe a change in immigration policy has affected demand slightly, but the demand for the housing that Main Street has so far outstrips the supply that it's not a concern. The stock's trading right now about 24% discount to my calculation of net asset value. We've seen the stock trade at a premium in the past to net asset value. So for new investors who are looking at it, I think it could be a great time. And for investors who already hold it, I'm very happy betting on Main Street long term. And I've said before, out of all the names in my portfolio, this is the one I worry about the least. Highly defensive business, extremely well run, fantastic CEO. I think you're going to see that continued 15, 20% compounding year after year after year or more.
Well, I know we'll see that clip somewhere. Bob will post it.
Bob is so good. By the time I get back to my office, I think he will have sent it out to me.
He will have emailed you about it. Okay, your third, so we're flat on the other names, but they were made just a couple of months ago and you're still holding. And we know you're still holding Propel. Yes, everybody, we're finally bringing up Propel. I saved it till now because it is both a past idea and you're still sticking with it. It is one of your pro picks today. It's down about 10%. Again, volatility in there. One of those lenders to people who don't have access to credit. So kind of in the same lane as goeasy. And unsurprisingly, it has also kind of struggled.
Mm-hmm. So let's talk about why it struggled. And then let's talk about what's actually happening at the business. Why has it struggled? So some of the reasons are the same as goeasy. Some of it is macro. So it's in a sector that people don't particularly like. The goeasy short report actually didn't help Propel. Propel was down over that number of days because people start making inferences. Oh, well, if there's a problem at goeasy, maybe there's a problem at Propel. What people don't understand is that aside from them both being Canadian listed non-prime lenders, they're very, very different companies. goeasy has physical branches. Propel does not. goeasy operates exclusively in Canada. Propel is primarily in the US, a little bit in Canada, and then growing in the UK. Propel is all online. Propel is all unsecured. goeasy is half secured. There's so many differences between these businesses that, while you can compare them because there's not a lot of good comps for them in Canada, they're very, very different businesses. So I think it's been hurt by the goeasy short report, the general weakness in Canadian small cap growth. And then on their most recent quarter, they actually brought down their guidance for Q4, which investors didn't like. But let's talk about that for a second. So they brought their guidance down for their loan book growth from 25% to 18 to 22%, which the reason they did that is they noticed the consumer was having a little bit of trouble in the US. So they tightened up their underwriting. So they essentially hived off the bottom 10% of the loans that they would normally approve. And they said, we'd normally approve these loans. We're not going to do that anymore. We're tightening our underwriting. When you do that, your growth will slow a little bit. But I guess my point is, most companies would kill to have 20% growth. And here's a company that's being punished for having 20% growth. And you're punishing the management team for being a little more cautious, when in my mind, that's actually the prudent thing to do. So when you look at the growth rate, it's still extremely impressive. I was chatting with the CFO recently. He talked about being highly confident that the company can grow at 30% a year for the next 5 years. So, and they've been growing faster than that. Their top line's been growing way faster and their bottom line has been growing extremely quickly as well. This company has a lot of runway in the US. They do have some runway in Canada, although I get the sense it's not a huge priority for them. And then the UK is going to be an absolute home run. They bought a small platform business in the UK. It's growing like crazy.
Is it also possible, like it came to market in 2021 when the vibes were great, and as you pointed out, look at consumer stocks in the US. It's clear that there is struggle out there. So it makes sense that Propel would be vulnerable. And And maybe is it just the fact that you haven't seen a long history of this company, so you don't know how they manage those cycles?
No, because the company actually has a 14-year history. So even though they've only been public for 4 years, they have a very long history. They've done billions of dollars of loans, millions of customers. A lot of companies might say they have very good tech, like Propel says as well. But I think the really important thing with some of these online lenders is the data, which Propel actually has. So I think we do know how they perform. What I think investors need to know is when they slow growth, they're doing that to preserve profitability. So the way that management is looking at the business is, what do we need to do to our underwriting to make sure that we preserve our margins and our profits, which is what they're doing right now. So it's a bit backwards, but the way to understand these businesses is when they grow faster, they look less profitable. And when they grow slower, they look more profitable. And it's kind of backwards because when they take on new loans, they have to take on provisions associated with those loans. So the more new loans, the more provisions, the less profits, and vice versa. So what you could see, and we did see this during COVID with some of the lenders, is when they slowed down their originations, their profitability went way up and they look cheaper. That being said, this is, I've said before, one of the best growth stories in Canada. I mean, I talked recently about the company with someone and I said, even if you just look at something as simple as top line, for example, when they went public in 2021, they were doing about $120 million of revenue. This year, they'll do $600 million. So sales have gone up 6x in 6 years. Again, not too many companies that I know of that can show me that. And now the stock's trading at 6 times earnings with a 4% dividend yield. So you've got growth if you're a growth investor. You've got valuation if you're a value investor. You've got dividend yield, plus management and insiders own close to half the company. So you talk about alignment. So when you look at my checklist, so to speak, of things that I like in a stock, this one's got it all. Yet the market's giving it no love. And I think that's going to change. We saw that last time the stock went down to 6 after the IPO, and then it went from 6 to 40. So I think, and I've said this before publicly, I'll say it again, I think this is a $100 stock within 4 or 5 years. And it's a $20 stock today.
From your lips. Let's see.
Well, we have it recorded, so
that's right.
Let's see what happens.
You are on the record and you come back in good and bad markets.
Yep.
So I do appreciate that. We talked about Constellation and how that you bought it for the first time in 6 years and you don't even buy large caps. Let's talk about baby Constellation, which is Lumen, spun out of Constellation. And in the span of less than 2 months, it has dropped 60%, almost 60%. What has gone on?
Yeah, I mean, I wish I could tell you definitively that I know exactly why the stock's down this much. I am scratching my head a bit over it. I mean, you would think that it could decline in sympathy with Constellation. That makes sense. You would think maybe that investors have the same concerns. Lumen's a bit of a different business than Constellation, so maybe I'll just talk about that for a minute for those who don't know the differences. Lumen was the media and communications group of Constellation before the spinoff. And then it got spun off, and they generally do way larger deals than Constellation. So they'll go to a company like Nokia, for example, and Nokia might have a division that they don't want anymore, or that a previous CEO started, or a business they don't want to be in anymore. But when Nokia sells that business, those customers might be customers of Nokia in other businesses. So they have to be very careful who they sell that business to. And Lumen has become a trusted partner for some of those big telecom companies in terms of these carve-outs, they call them. So aside from the Constellation issues, I think one of the things that's hampered Lumen is they haven't announced a big deal in a while. And typically the way these stocks look is they announce a big deal and investors get all excited and they recalibrate their numbers and they come in and buy the stock. And then it kind of goes quiet again until we see earnings or M&A. So outside of the general Constellation issues, which we talked about at length, and lack of large M&A, I can't really tell you why the stock is down so much, but I can tell you it's a very high quality compounder. It's Constellation type DNA, Constellation type financial metrics, again, trading at, 20 times earnings.
And so it's your top idea. Where do you think it goes from here?
I think you're going to make 20 to 30% a year on this stock for this foreseeable future.
Good. I own that one too.
Okay, good.
And I'm down. Not been a good year for my quality picks.
Quality is out of style. That's what I said earlier.
Talk to me about this one, your third pick, an Israeli company, ZOMD, and it's small. It's a little teeny tiny thing. Why do you like it?
Well, as you know, we're not afraid of small. And I think one of the things that I like to do is try to find these really high quality growth stocks early before other investors are onto them, because that's when you can really do very well in the market. You find these companies that are great businesses that nobody knows about. They're trading at these low multiples. And then over time, as they work through the call it Bay Street ecosystem in terms of, going out and seeing the brokers and then starting to do presentations and eventually getting some analyst coverage, which we just saw with this company. ATB Financial picked it up about a month ago. So it's just starting to get out there, but most investors probably haven't heard of it. Israeli ad tech business. And I followed it for a couple of years before I bought it. I met them at a few small cap conferences and I was really intrigued, but they had some trouble in the business that they were cleaning up. And they cleaned it up a couple of years ago. And then the revenue and the profits just started to take off. I didn't buy the stock right away. I started looking at it around 60 cents. I managed to get, and it was also a liquidity because it's pretty well held by insiders. So I managed to buy a block of stock several months ago, and then the stock almost doubled right away. I know, yeah. Which I think
good for you.
I bought it at $1.17 or 18, and then we went, almost double right away. They went out to a couple conferences. They put out a couple quarters. This company has really blue chip clients. And when I say blue chip, I mean, I'm talking Amazon, Nike, Shein. Am I saying it right, Liam? Shein or Shein? I don't know.
The NBA.
Okay. Anyway.
The NBA, McDonald's.
So those are the types of customers they have. And what they've really done with these customers has been a land and expand type of model. So Amazon might come to them and say, hey, we want to try out your technology. We'll let you start in the US. And then if you do well, we're going to give you the UK and we're going to give you this country. So that's what's been happening is they've been landing these Fortune 500 brands and then expanding with those brands. And I can't tell you that I'm an expert on ad tech or technology per se. Again, it's one of those sectors where everyone's going to say they have the best technology. The proof to me is in the customer base that they've been able to attract. Let's face it, these customers can use whoever they want. And they're using this small little company for their ad tech. It's actually really interesting. And then the second piece is if you just look at the growth and the financials, the company's growing very quickly. Their margins are very high. This would be a bigger position for me, but they don't have a ton of history, number one. Number two, ad tech can be highly cyclical as the economy is growing, expanding. And number three, the company doesn't, although they talk to the street, there's no guidance. Up until a month ago, there was no analyst coverage. So I had my own numbers. And those numbers were, educated guesses, so to speak. So I really like the business. I really like the financials. I really like the growth. So it's a starter position right now, but I like to come on the podcast and give viewers maybe an early look at some of the stuff we're working on in companies that they're probably going to hear more about in 2-3 years mainstream that they're just not hearing about now.
The ticker is ZOMD on the venture. And yeah, the revenue, it's about to hit 100 million. A couple of years ago, it was below 70 million. But again, I feel like it's worth saying, you have said it, but such a small cap. Let me look up the market cap, 170 million. So not as teeny tiny as NTG, for example. But you have to be prepared for a 20%, 30% sell-off.
Yeah, and sometimes the best way to deal with that is position size. And what I mean by that is if you're going to own some of these smaller racy names, you can take a bit of a basket approach and say, I'm going to buy 3 or 5 of these names in small proportions and 1 or 2 of them might work and I'll add to those over time. But I think with small cap in general, that's something that investors really need to think about. I mean, I've got a almost full allocation to small cap because that's what I do. But for most investors, they want the returns of the small cap market, but they don't want to suffer the volatility. And the way to do that is by sizing your positions properly. So in your portfolio, you may want a 10 or 15% weighting to small cap. And if you get a year where you're up 30 or 40 or 50%, that's really going to help your returns. And if you get a year where you're down 20 or 30%, it's not going to kill you if it's only 10% of your portfolio. So I think sizing is the way that investors can get comfortable if they're not comfortable with this volatility.
That's Jordan Zinberg of Bedford Park Capital. Don't miss our next episode. We've got Bob Elliott talking macro. So from the micro to the macro, Bob is with Unlimited Funds and he's the former head of research at Bridgewater. And right now, macro is a little bit of an anxiety in the markets. Investors are worried about whether or not we're going to get a rate cut in December. So if you've got macro questions, you can email us at questions@inthemoneypod.com, and we'll see you on the next episode.